Well, to respect everybody's time, I'm going to actually start, right away. First and foremost, good morning and welcome to our office meeting. This is not your just typical smaller meeting. We thought it'd be ideal to provide you with an update of where we were, where we are, and where we're probably going. We have with us today somebody who's been part of our organization and with meetings before. We consider him a friend and a very smart individual, and excited to have Shaun with us. I'm going to ask everybody to mute their mics if you're not going to be speaking, just to make sure that there's no background noise, and to also make sure that if you do have a question, there is a chat that you can actually write a question. I will monitor the chat box, and as well, I will pause the meeting for you to ask questions. If you can please hold your questions though to the end of Shaun's presentation, it would be much appreciated, because he has a lot of information and we want to make sure that he has everything in his mind on track the way he's wanted. So with that, I want to introduce Shaun Hildebrand. He's the President of Urbanation, a real estate research and consulting firm specializing in the GTA condominium and rental markets. Shaun manages the Urbanation team and is responsible for leading market intelligence for the company's subscription reports and project feasibility studies, and directing new research expansion. Shaun has acted as a key spokesperson on the local real estate market for over 10 years, providing highly quoted market insights in the media, delivering industry presentations, and preparing forecast reports and customized research for a diverse range of clients. Prior to joining Urbanation in 2013, Shaun managed the GTA housing market analysis team at Canada Mortgage and Housing Corporation. Shaun, welcome to our RE/MAX Ultimate meeting, recap meeting for the first 6 months, I guess, almost full 6 months of 2020. Nobody expected to have this type of a market or this type of environment, to say the least. Just to give you some insight, we had our annual general meeting in late January, and we were forecasting something completely different than what we've experienced today. So I'm sure it's no different in your office and the conversation that you've had, but really excited to have you here. As I said before, you are a friend. You're somebody that I value the insight for, and I want to thank you for joining us today with RE/MAX Ultimate.
Excellent. Thanks for having me. Really happy to be here. I'm just going to load up the presentation. 1 second. So I need to have screen sharing permissions.
Okay. So Rebecca, if you're there, can you please provide the sharing permissions? Let me get you here, Shaun, on the screen. And once I get you on the screen, I'll actually could possibly do that as well. 1 second.
Sure.
Yep. Where do I go? Right here?
Yep, 3 dots.
3 dots.
Make host.
There you go.
Okay.
You got access.
All right, let's see.
Thank you.
All good? You can see the screen okay? Okay, excellent. Well, thanks again for having me join this morning. Obviously, very interesting times. And we've been tracking the market pretty closely as the situation has evolved in the COVID-19 period. Obviously, we were seeing, as Tim mentioned, a lot of strength, a lot of momentum heading into 2020. And I think everyone was pretty optimistic about the year. The real estate board was projecting 10% growth in prices, sales above 90,000 units. It looked like we were on track to have a really good year in 2020. And then obviously the pandemic came in and stopped everything in its tracks. But I think, for the most part, everyone's been pretty impressed with how the market has transitioned so far. Obviously, sales activity, total volume is down pretty substantially, but the market for the most part has remained very much in balance. Supply has been behaving very well. We haven't really seen any signs of distressed selling. And prices have come off maybe a little bit from their highs in the early part of 2020, but for the most part have been holding steady. And in fact, as I'll show you in the slides throughout the presentation, pretty consistent still year-over-year gains in price, even though they're looking a lot more modest than what we were seeing heading into the period. But for the most part, things are transitioning, I would say, in a fairly orderly manner. So I'd like to kind of start off by taking a bigger picture look at what's happening. I think we need to sort of take a look at the macro view of the market in order to really understand kind of what's the driving fundamentals here, and really what's the outlook for the GTA real estate market to eventually stage a full recovery when it comes to sales activity. So obviously, the first thing we have to look at is the health crisis itself. And I have to admit, this is the first time that I've consulted infectious disease data when doing a market outlook presentation, but here we are. So you can see on the chart on the left, Canada has been progressing very well along its curve, successfully flattening the curve, and now over the last number of weeks, seeing declines on a consistent basis. And I guess now the conversation has shifted from a successful transition in managing the crisis to one where, how do we successfully reopen the economy across the world and, not end up in a situation where we have to enter into another lockdown. And I think it's become sort of universally accepted that there will be a second wave, and we've seen some evidence of that in some of the countries that were hardest hit initially and have been earlier on in making progress towards opening up business. But, I think for the most part, if you sort of progress along the reopening plan in a staged manner, the idea is that this second wave can be controlled and will eventually get towards that third stage of reopening. And as you can see across Ontario, we've been very successful as well relative to the other provinces and the rest of the country in seeing the flattening of our curve and seeing a sustained downward number of new cases on a daily basis. Really, the goal for the province was to get under 200 cases a day. And that's been the case, as we can see from the 7-day moving average there. And then as that happens and it continues to move down, the idea is that you'll move through these 3 stages over each of them over a 2 to 4 week cycle. So we know that phase 1 started in May 19th, phase 2 as of tomorrow. Pretty much every region of the province, except for Toronto, Peel, and Windsor, entering into phase 2, so exactly a month after phase 1. And, if everything continues to progress according to plan, in another month from now, we could see a movement to phase 3, where all workplaces reopen responsibly, of course, but obviously that puts us on the right path towards restoring the economy back to where it was in the pre-COVID-19 period. But nonetheless, this year is going to be one of unprecedented decline in economic activity. And this is unique in the sense that it was forced on by a government shutdown. It didn't happen because of the regular happenings of the business cycle. But nonetheless, we'll see what's projected to be about a 6% decline in GDP for 2020. And as you look back to previous recessions, that's about at least two to three times steeper than what we've been used to seeing in terms of economic declines during a recession. And the projections right now from most bank economists are looking towards a almost full recovery through next year. Not a total recovery, that is expected to happen at some point in 2022. But as you can see, most expecting a rebound of about 5% GDP growth next year as more and more businesses reopen and consumers and businesses begin to sort of revert back to normal activity. And really, the decline in economic output this year could have been much worse. In fact, when we were looking at these projections early on in March and April, we were seeing double-digit declines in GDP growth projected for 2020. But the unprecedented amount of fiscal support and monetary support that came in, not only in terms of its large quantity, but how quickly the government reacted vis-a-vis other recessions, is putting a nice floor under the economy and putting it in a very good position to see a resumption of growth as we move through the second half of this year. So, look at these numbers. They're unprecedented. Over $150 billion in federal budgetary spending announced. That was as of a month ago. So that's increased since, as we've seen some of the the emergency programs like SURB being extended. And then obviously this is resulting in a massive budget deficit for the country for the next fiscal year. But recognizing that, Canada was actually in a pretty good fiscal standing point heading into the crisis. Our debt to GDP ratio is only about 30%. And that's much better than a lot of other big countries around the world. It's expected that our debt to GDP ratio might rise to around 50%, but it's still relatively good standing when you look at it on a global basis. And in terms of providing monetary fiscal support, the Bank of Canada, obviously, as we know, reacted very quickly, swiftly, and reduced their overnight rate back down to a record low of 0.25%, which is effectively the lowest it can go without heading into negative interest rates. And they've also, for the first time, entered into a quantitative easing program where they're buying at least $5 billion in government bonds every week. It's going to add up to $200 billion in purchases over the course of the program. And this is providing much needed lending liquidity in the mortgage market in particular. And as this has happened, it's actually been very successful in the sense that it's reduced credit spreads basically back to where they were in the early part of March. So you're not seeing credit freeze up. The amount of liquidity being injected in the system from the Bank of Canada is allowing consumers to continue to borrow. It's allowing banks to continue to borrow amongst each other and corporations. And this is really helping to provide stability for the economy as we move through this next stage of the recovery. And as you can see on the chart, or the clipping there on the right, there's a variety of different scenarios that could happen here because really, the evolution of this recovery really does depend on how the health crisis evolves. But the working assumption right now is that we'll see something akin to scenario 2, which looks more like a U-shaped recovery. And we'll probably enter back to the level of economic activity that we saw pre-COVID by around the early part to mid part of 2022. It's possible that we could see something that looks like more of a scenario number 3, where we reopen the economy, we see a spike in cases, things get pulled back, and then we sort of enter into a bit of a zigzag recovery or a W-shaped recovery. I don't think anybody right now is projecting what's considered to be an L-shaped recovery, kind of a tilted L, which you can see there at the bottom in terms of scenario 4. That would look something more like a Great Depression. And, this is not your typical recession, as we talked about. This is very unique in the sense that it was forced on by the government in terms of a shutdown to deal with the health crisis. And it's believed that as the economy begins to reopen, that growth will resume and eventually return back in short order. You have to also realize that the Canadian economy was hammered by both COVID-19 and a collapse really in oil prices. And we've seen really a disproportionate impact across different sectors of the economy. So less impacted sectors would include organizations and companies such as food stores and online retail, obviously. And then most impacted would be restaurants and air travel. And it's believed that even as these industries begin to reopen, they're going to continue operating with less capacity and less revenues than they were in the pre-COVID-19 period. So in that sense, there are going to be lasting scars. So looking at the state of household balance sheets here in Canada heading into the crisis, we see that mortgage arrears were at record lows in the province. And in fact, as of year-end 2019, the percentage of mortgages that were in arrears was only 0.008%, which is basically 8 out of every 1,000 mortgages were 3 months or more behind on their payments, which is a tiny fraction and one of the lowest levels that we've seen. Now, helping to support this level of low arrears has obviously been the mortgage deferral program that's been in place. And that's providing deferrals and skip a payment programs to what's totaled over 700,000 mortgage holders in Canada. It's equal to about 15% of the overall number of mortgages in banks' portfolios. And that program has been pledged to be in place for 6 months. So, we're about halfway through it, but it's believed that if it's required to remain in place for longer, then that will be the case. And the government and the Bank of Canada has done a lot of work in recognizing that mortgage deferrals are a very, very effective tool in helping to stabilize not only the economy, but the real estate market. And they've sort of looked at other crises that have used this policy, such as the Fort McMurray crisis, for instance, few years back where everyone kind of lost their jobs and you had all these fires and all these natural disasters, and it was a big problem. And the mortgage deferrals actually helped to create a lot of stability for that market. So this is believed to be the case as well. But naturally, as you know, there's continued sort of impacts from COVID-19 on the job market lasting through this recession. Eventually, as the program gets clawed back, the expectation is that we will eventually see some increase in mortgage arrears. The Bank of Canada is projecting that they could rise to about 0.8% from 0.08% by around the third quarter of next year. That would basically put them back up to where we saw them at the height of the recession in the early 1990s. So it's not something to overlook. It's something really to pay attention to. But it's not nearly as dire as the prediction from CMHC, which believes that they could rise potentially to 20%, which would effectively mean that almost everybody who's deferring their mortgage right now will eventually default, which I think is probably unrealistic given the fact that the economy is eventually going to reopen. And a lot of the job losses that have occurred are really just layoffs, and a lot of them will be rehired back as the economy resumes. So using that as their basis, they actually came out with a forecast predicting that prices could fall by 9 to 18% from their peak over the next year. So take that into consideration, that they're sort of looking at this from a worst case scenario. And you know, the mortgage deferral program that's been in place is actually doing a lot of good. But if you take a look at the chart on the right, it does show that household debt has been stretched. The dark blue line there shows mortgage debt service ratios across time, essentially showing you that despite the fact that interest rates have remained at record lows, the percentage of income that's having to go towards servicing mortgage debt is really at one of the highest levels that we've seen over the last 30 years. It's not as high as non-mortgage debt, which is going to be the first to default if there is problems. So people will hang on to their homes for as long as they possibly can. They'll default on non-mortgage debt first, but nonetheless showing you that there are some headwinds here as households are dealing with record levels of debt relative to their income. Now, it doesn't suggest that they're all going to default, but it does suggest that we have some headwinds as we move through this recovery. But it's been interesting to see the breakdown of these mortgage deferrals as they've occurred. And CIBC did a very interesting study on this. And basically what they found was that there was a very high proportion of mortgage deferrals that were occurring amongst those with lower credit scores. And those with lower credit scores ultimately represent a fairly small percentage of the overall mortgage portfolio. So I think this speaks positively to the fact that there's, you know, a limited case to be made for a huge spike in mortgage arrears as a result of the crisis. Yes, those that are financially stressed and have lower credit scores may be at higher risk of default, but they represent a fairly small minority in relation to the overall mortgage portfolio. And then if you look at this sort of geographically, most of those scores are not actually in Toronto or even in Ontario for the most part. They're focused out west, they're focused in Quebec. So Ontario actually stands to benefit fairly well relative to the rest of the country based on our lower arrears numbers and the fact that our credit quality here in the province is actually relatively high. So I wanted to kind of work through this CMHC forecast to kind of illustrate what this all means, because when you look at it on the surface, it sounds pretty dramatic that we could see, you know, a 9 to 18% decline in housing prices. Actually, the forecast for Ontario was 10 to 20%. But all of this is based off of the Q1 2020 high that we had coming into this market. So if you take that as our starting point, average resale prices in the GTA were about close to $900,000. So they had risen 15% over the past year heading into COVID-19. So we were seeing a lot of momentum. The declines that they're actually projecting come within sort of an upper, mid, and lower bound. Using those various scenarios, that 10 to 20% correction would actually still leave housing prices in 2020 higher than what they were in 2019, based on that strength in prices that we had heading into COVID-19. So take that into consideration that, you know, these are projections made off of a peak in activity that occurred early in the year. And as we move through next year, the outlook is so uncertain that it's too difficult to call what the growth rate will be. So perhaps it could have a slower recovery, and under that scenario, you know, we could see average prices down 7 to 12% next year. But you know, take into consideration that this is based on pretty negative economic assumptions. And, for the most part, I think everyone sort of assumes that the economy will bounce back fairly quick, even though there's going to be some lasting scars. It's quite unlikely that we're going to see this scenario actually play out. And in fact, it's actually pretty rare for prices to decline that quickly. Yes, as I'll go back to the previous chart, yes, we did see a pretty sharp correction in 2017 after we saw a very strong run-up in the period before that. So we saw a 30% jump between Q1 16 and Q1 17, followed by a 14% reduction in the following year. But remember, this came after government policy intervention, right? We had a foreign buyer's tax. We had a tightening mortgage credit that happened during this period. We had the whole fair housing plan, I think, changed buyer psychology. And it was really just kind of a short run decline after a short run increase. And the market stabilized very quickly after that. But in terms of a longer downturn that happens during recessions, it's actually very rare to see prices decline quickly. And if we can look back to the early 1990s recession as an example, I don't want to spend a ton of time on this because I want to talk more about what's happening in the current period, but just for food for thought, take into consideration that during the early 90s recession, we saw a 151% increase in housing prices in the GTA during the late 1980s, so right before the recession. Lots of spec activity happening during this period of time, and we can probably have an entire presentation about what was happening during then. But basically what happened was the recession hit in the early 1990s. The government was very slow to react and in fact kept interest rates high for a time. And as you can see, even despite that 151% increase in prices only really adjusted by about a fraction of that increase. And it happened very slowly, but it happened over a prolonged period between 1990 up to 1996. And you didn't see, a big sharp initial reaction in terms of price declines, and showing you that there's a real hesitation here and there's a reluctance to sell below market value, and people who don't have to sell simply won't. And you see supply come off the market and prices end up being sticky as a result. So I think this is sort of what we're seeing right now, right? Prices have come off a little bit from their highs in the early part of 2020, but for the most part, they've held steady as supplies remain low. Now, we can't obviously talk about the fundamentals of the GTA without looking at both the economy in terms of employment as well as immigration. And we have to address the elephant in the room that, Canada has seen 3 million job losses between March, April, and May. And actually, we saw a little bit of a recovery in May, but that didn't happen in Toronto and Ontario. In Toronto, we've seen about 600,000 job losses on the surface. So it took about 18% out of our employed labor force. So it wasn't insignificant, but recognize as well that we saw very strong employment growth heading into this period. We also have a lot of people that are underemployed. In fact, more than 2 million people in May were actually still working. They're counted as part of the employment statistics, but they were working less than half of their usual hours due to COVID-19. And the severity of the situation can be seen through how many people are actually on CERB benefits, those getting $2,000 a month. Over 8.4 million received as of June 4th. And you can see that, the unemployment rate has spiked. It went from 6% to 15.4%. But I also think it's important to point out that under the economic projections that have been coming out, we could see a recovery of close to 90% of these jobs by the end of the year, right? So we're seeing unprecedented declines in employment today, but we're going to see unprecedented increases in employment in the second half of 2020 as we progress through this three-stage plan. And there's a lot of incentive for employers to rehire their staff back, right? They have the wage subsidy program. They have interest-free loans that they're being offered. And, there's going to be a big increase in people moving from that position of being technically unemployed to being employed again. It's also important, I think, to recognize that the job losses that have occurred have been proportionately stronger for the younger working population. So those kind of under the age of 30, concentrated between the ages of 15 and 24, and really those that are in lower paying sectors such as retail, accommodation, and food services, typically not full-time employment, typically paid by the hour, and typically not your primary source of housing ownership demand. And I think this is one of the reasons why the ownership market has held up relatively well with respect to the overall real estate market because of the fact that full-time salary employees in higher paying sectors, which have a higher concentration of employment in the city of Toronto, have actually been relatively unscathed. Yes, we've seen some decline in employment, but not anywhere near the declines that we were seeing for this more vulnerable group. And you can see from that bottom point there that the industries relatively less affected include sectors such as finance, real estate, utilities, public admin. And I think this is really one of the reasons why we continue to see some stability, whereas the younger cohort that's been more affected, we've seen the declines happening in the rental market more so than the ownership market. Also, heading into this, Toronto, as has just been reported, was the fastest growing city in North America last year. And that was because of how strong immigration has been. As you can see from the chart on the left, net migration into the GTA reached nearly 95,000 in 2019, the highest levels that we've seen in about 20 years. But on top of that, over 44,000 non-permanent residents entered into the country. So non-permanent residents would include categories such as foreign workers, foreign students, which are big drivers of rental demand downtown in particular, and a little bit of a small increase in net migration from people that are moving in from other provinces into Ontario. And, you know, we also did see a net outflow of some people that were living in Toronto moving to other parts of the province. And I think this really talks to the inadequacy of housing supply in the region. The fact that we have this level of immigration, but we also do see some outflow because of affordability, because we haven't been building enough new housing, speaks to the underlying mismatch between demand and supply in the housing market in the GTA. Because if you look at overall net migration, you account for the inflows and you also account for that small outflow, you're looking at net population inflows of nearly 100,000 a year over the last 2 years. And I know that 100,000 a year number has been thrown out a lot over the years, but it's really only been true over the last 2 years. And if you look at that number and you assume that the average household coming into the region is about 2 people per household, that would relate to housing demand of about 50,000 units a year, right? We haven't been building anywhere near that level of demographic demand. I'll talk about that in the next slide. So obviously, heading into 2020, we were expecting to see a very high level of immigration for this year. The federal government has very aggressive immigration targets nationally for each year heading out to 2022, and that's expected to continue to extend. And the current immigration minister is very, very much on the course of trying to increase these immigration targets year after year, because they recognize that without this level of immigration, Canada really has no chance of sustaining its current population growth because of the aging population and declining birth rates as well. The only way to sustain population growth at its current pace is actually to hit these immigration targets. So they're zeroed in on trying to get these levels achieved. Now this year, because of restrictions on travel and other complications due to COVID-19, we're going to see a decline in immigration, and we're starting to learn more about what those numbers are starting to look like. In April, only 4,000 permanent residents completed their landing in April versus what you would normally see for the country, which is 25 to 35,000 a month. So really just a fraction of that. But there is expected to be some recovery starting in the second half of the year, as the government has been very aggressive in issuing more express entry invitations. And I've been hearing more about visa application centers opening up more around the world. And as this happens, as processing normalizes, lockdown and travel restrictions begin to ease, you could expect to see those immigration levels rise as we move through the rest of this year and into next year. Now, it's unlikely that we'll hit those immigration targets, but I think we'll recoup a lot of those losses as we move through the next couple of years. And obviously, Toronto stands to benefit, as you can see from the chart on the right, representing a 10-year high share of new immigrants that come into the country on an annual basis. So when you look at these numbers, when you look at population growth, you look at what housing demand has been in the last couple of years, which is about 50,000 units a year, and you can relate that back to housing construction starts, you can see how much of a mismatch there's been between demand and supply. We haven't been building anywhere near 50,000 units a year. And in fact, last year we saw housing construction starts drop to 30,000 units a year. So we were underbuilding last year by a pace of about 20,000 units. And again, I think this is one of the reasons why Toronto is going to come out of this situation looking pretty good, is that we weren't overbuilding, right? Usually in housing downturn, a typical housing downturn, you see not only rapid price inflation heading into the downturn, but you also see overbuilding happening. And the opposite has been happening here in Toronto. We've been underbuilding for so many years, and a lot of that is because of a very long-term and notable downturn in single-family home construction. And as a result, you've seen the share of apartments that are representing overall housing construction continue to rise. So condo apartments, rental apartments, they're going to be key in addressing this shortage coming out of this situation. And the fact that we still have low supply in the marketplace really speaks to how low the building volumes have been over really much of the past 10-year period. So now looking at the new condo market, a couple months ago, we released our Q1 stats. We don't have any Q2 stats yet to share, but we will in the coming weeks. So we'll be able to provide you an update with respect to those numbers. But when you look at new condo sales heading into COVID-19, they were extremely strong. We had a lot of momentum in the new condo sector. Over 5,600 new condos sold in the GTA, up 85% year over year from a pretty low level in Q1 2019, but it was still about 16% above the 10-year average. Absorption within new launches was extremely strong. So out of the 4,623 units launched for pre-sale in the first quarter, 71% of those were sold by the end of March. And part of the reason for that strong absorption was the fact that pretty much all of these launches happened in February. Really nothing was launched in March, maybe one project. So I think maybe the new condo industry benefited from the fact that we didn't see any new launches in March, right? We didn't get caught up in that COVID period really, because a lot of that activity was brought forward into the early part of the quarter. So there really wasn't a chance for projects to launch, not do well because of COVID-19, and then see inventory rise, right? Everything was well sold heading into COVID-19, and that really speaks to how strong the market was heading into the situation, because we hadn't seen new launch absorptions above 70% since 2017. 2017, as you can see from the chart, was the peak in the market, and we were getting really close to those peak levels again. And the chart on the right there shows the 4-quarter rolling total, showing you that we were pretty much right back up to peak levels in terms of overall sales volume. But what's different about the new condo market now is that the distribution of activity is becoming more evenly dispersed across the region. And we saw almost an even number of units launched in the 416 and the 905, and really strong absorption across the board. In the city of Toronto, almost 80% of the units that launched in the first quarter were sold, and sold at record prices, over $1,300 a square foot. And as that's happened, what we've been recognizing, and I'll talk about this in the next couple of slides, is that as prices have reached $1,300, $1,400, in some cases up to $1,500, $1,600 a square foot in downtown Toronto, we're starting to see a movement in demand towards lower priced markets across outer parts of the 416, Etobicoke, Scarborough, North York, and into the 905 in particular. And as you can see, you usually don't see this high of an absorption rate in new launches in the 905. Usually it's around 40 to 50%. But in the first quarter of 2020, the 2,000 units that launched were 60% sold. It was one of the highest opening quarter absorption rates that we've seen ever for the 905, and at record prices as well, $895 a foot. But recognizing that how big that gap still is between prices in the 416 and prices in the 905, we haven't seen that diversion in prices really ever. So as that's been happening, some demand is starting to filter into the more affordable parts of the market that are priced under $1,000 a square foot. And we're starting to see investor activity that was normally primarily focused in Toronto, spreading itself out as well across the GTA region. And the chart here on the left is really just sort of an illustration of how investor demand tends to react to the broader macro picture. And what we're overlaying in this chart on the left here is the percentage of new launches that get absorbed at opening. So, when new launches at opening are high in terms of their percentage absorption, it typically indicates a very high percentage of investors, because as we know, the developers will first offer their units to their Platinum VIP agents, who then go to their investor clients. If they're sold quickly, it usually tells you that there's a lot of investor interest. And as you can see in this chart, there's a very high correlation, in fact, an 80% correlation between investor interest in the new condo market and what's been happening in financial markets. So as financial markets do well, which would basically tell you that the outlook for the economy is strong, it provides investors with confidence as well. Perhaps they're taking some money out of financial markets and putting in real estate, or just more willing to invest in real estate because they recognize that the underlying financial backdrop is strong. It tends to lead to stronger levels of new condo absorption. And you can see this trend, through the recession, through the recovery, looking pretty strong in terms of its correlation. So interestingly, as financial markets plunged in the later part of March 2020, we didn't see any new launches happen. So there wasn't really an opportunity for these absorption levels to plummet. And what we've been seeing since those March lows is almost a full recovery in equity markets. So again, this provides added levels of consumer confidence. So when these projects do begin to launch, we should see a fairly good level of absorption as the underlying financial macro backdrop continues to improve. And the chart on the right here shows you as well that I'd say condo buyer confidence has been driven higher by the fact that we've seen new condo prices rise every single year for the past 23 years, and averaging 11% growth year over year in the first quarter of 2020, 10-year average of 7%, 20-year average of just below 7%, 35-year average of 6%, very, very consistent with what you would see coming out of financial market gains as well. So the condo market has become a very, very stable and important vehicle for investment activity, and it allows the market to have quite a bit of confidence in investing further into the future. The situation that we're seeing right now is nothing like what we saw in the late 1980s, right? We saw housing prices in the condo market inflate extremely quickly, as we talked about, followed by a correction. What we're seeing is pretty consistent gains in the condo market. Yes, we saw an increase in activity in terms of price appreciation earlier in the year, but it's starting to flatten out, and those gains have been very consistent across time. So in trying to kind of gauge when these new launches were going to occur, because there was a lot of projects that were planned to come out in the spring that obviously were put on the shelf as COVID-19 came into effect, we asked our clients, which represent the largest developers, brokers, suppliers in the industry, out of the projects that you expected to launch this spring, when do you expect that you will be launching them now in light of what's happening to the current market in terms of COVID-19's impacts? And this survey was done in April, so it was done a couple of months ago, but still provided, even during that very highly uncertain time, indications that most of the launches that were expected to come in the spring are in fact being delayed until the fall of this year. So it's not like they're being indefinitely put on the shelf. Most of them were actually just expecting to be delayed for about 6 months. And this is fairly typical for what you see during housing downturns. As you can see in the table below, during the 2009 recession, developers held back very quickly and really didn't launch barely any new product for 3 quarters following the recession. And then as you got in towards the fourth quarter of 2009, as absorption started to pick up and buyer demand and confidence started to improve, you began to see more launches occur. So I think the same sort of thing is going to happen. Actually, so far, I'm seeing that some of the launches that we were expected to be coming out in the fall are actually being pulled forward into the summer. So, things I think are improving, and confidence within the development industry, I think, is improving as well. And the chart on the right there just shows kind of an illustration of what the expectations are in terms of pricing and absorptions for new launches. Most of the feedback that we received was that pricing will pretty much hold steady, perhaps with a small increase in incentives and maybe a little bit more of a moderation in absorptions versus where the market was pre-COVID-19. But for the most part, the market is going to be resembling fairly closely in terms of pricing for new condo projects, what it looked like in the pre-COVID-19 period. And really, if prices came off 10%, developers simply wouldn't launch. They'd hold back launches. So supply would remain low and continuing to prop up prices. So that's kind of the expectation, is that we'll see some delay in new launches happening probably towards the later part of the summer into the fall. Expect pricing to be very similar or maybe a little bit lower than what it was in the pre-COVID-19 period. But I also wouldn't be surprised to see it at the same level or in fact slightly higher. And some of the launches that we've been tracking, the limited number of launches that we've been tracking so far, have actually suggested prices holding up very steady from what they were back in February. And really, the reason behind this is the fact that inventory levels remain so low. Unsold inventory in the GTA new condo market at about 15,000 units. It sounds like a lot, but it really isn't. And when you sort of relate that to the total percentage of units that are in development, which is over 100,000, it sort of shows you that close to 90% of all the units in development are actually well sold, or they're already pre-sold. And, you know, once you get to around 20,000 unsold units is when the market becomes softer, and we're at least 5,000 units below that. So everything is highly absorbed, low inventory, but, you know, I wouldn't be surprised to see more project cancellations this year or into next year, to be honest with you. And when we broke down these statistics, what we found was that there was still a pretty significant number of units that were in pre-construction. They hadn't broken ground yet, and they were launched over 2 years ago at prices that were less than $800 a square foot. And as you can see from that table, that's 20%, 25% below what other projects that were launched over the last year to 2 years have sold for. So at that price level, and based on the fact that they've been sitting there for so long, unfortunately, these projects just wouldn't be feasible. There's just no way that they can make the numbers work. And my expectation is that these developments will probably use COVID-19. What better excuse than a pandemic to get out of contracts? So unfortunately, I think we'll see some more project cancellations this year. And, you know, it's not something we haven't seen before. You know, 2018, we had over 4,000 cancellations. But, you know, it's still going to represent, I'd say, a pretty small proportion of the market. But I'm just saying this to prepare yourself for some of the headlines that, you know, there are some projects that are stuck sort of in pre-construction that, for whatever reason, they didn't get their approvals in place quickly enough. Construction costs increased, and it's just no longer feasible for them to proceed. So expect there to be some cancellations, some more cancellations on the horizon. Breaking down new launch sales over the last 6 months heading into Q1 by area, we see some of the more familiar submarkets at the top of the list, like Downtown East. Downtown East has been probably the strongest submarket in Toronto for new condo sales over the last 3 to 4 years. Continued to be the case in Q1, over 1,000 units sold between Q4 2019, Q1 2020. But we're also starting to see some new emerging markets show up on this list of top 10. Markets like Thornhill that we usually don't see, Downsview, Scarborough South, even Pickering, Brampton, Oakville North. Like, these markets usually would see, you know, a couple projects launch, a handful of units sell. Now they're showing up in the top 10 list of new launch sales. And as you can see from the chart on the right, offering substantial discounts versus the downtown markets. Like, if you take a look at the overall average selling price for new launches in Q4 2019 and Q1 2020, it averaged about $1,060 a foot. But that reflects pricing in downtown markets between $1,300 and $1,500 a square foot, and pricing in the suburban markets that are well below that level, like Thornhill, $850 a foot. Pickering, less than $800 a square foot. Brampton, $800 a square foot. And Oakville North, $750 a foot. These are high values for these submarkets relative to where they were coming from, but they represent such a substantial discount versus the rest of the market that they're starting to outperform. And we're beginning to see a dispersion in activity across the region as buyers look for relatively more affordable product. And, you know, we're starting to see this come through in the limited number of launches that have occurred in the post-COVID-19 period. We've been able to confirm sales at 2 launches. We're still confirming sales at a couple of other projects, such as the Taylor. There's another one out in Thornhill that recently launched. And we have another one, another Daniels project that's just sort of firming up sales as well. But so far, you know, we've seen limited releases at projects such as the second phase of Notting Hill, 76% absorption even during COVID-19 with a limited release of units of 128, but $915 a foot. This is north of Etobicoke, kind of Eglinton and Royal York, selling well because it's on future transit, very close to the future Eglinton LRT extension, and offering value well below the rest of the city of Toronto. That's, as I mentioned, above $1,000 a square foot. And then once you get out into the 905, I mean, the Charlotte boutique project near downtown Whitby only launched about 60 units, but, you know, right at launch, it was half sold at less than $600 a square foot. So price point really matters in today's market, and we're seeing that drive absorption. And this was really the case heading into COVID. When we looked at sales volumes for 2019, they were actually highest in the 905 region for the first time ever. the 905 region represented the highest volume of new condo sales in the GTA, outnumbering the number of new condo sales that happened in the former city of Toronto. And as you can see, the former city of Toronto actually saw sales activity decline to its lowest level since 2013. And it wasn't because of demand, it was because of supply. There simply isn't as many launch-ready sites in the downtown market as there once was several years ago, as these development opportunities are starting to spread themselves out across the region. And it's partly as well because of price point. When you look at the average price per square foot in the former city of Toronto, downtown Toronto essentially at $13.50 a foot, even with the 600 square foot average size, you're looking at close to $800,000 as your average price point there. Whereas if you were to take that same size unit and apply it to the price per square foot in the 905, you'd be paying like, you know, less than $500,000. There's a substantial discount there that buyers, I think, are recognizing. It really isn't a matter of price per square foot. It's a matter of what the overall price is. And if you can offer a one-bedroom unit less than $500,000 in a good location in the 905, it's going to sell extremely quickly. Whereas that same unit that might be priced at $750,000 downtown, well, that's where I see a little bit of deflation in price, right? Those very highly expensive downtown core one-bedroom units that are approaching $800,000 are seeing a little bit of a discount now because of what's been happening in COVID-19 and the fact that you can see these substantial discounts out in the 905. Part of this is also due to the fact that rents have declined. If the value of a rent has declined, then the inherent value of a pre-construction project should also be reduced, because the value of a pre-construction project is based not only on future price appreciation, but what you could ultimately rent the unit out for. And we'll talk about the rental market as we kind of progress through the presentation. And I have some more material here, and I'm looking at the time, so I want to kind of go through this fairly quickly, but I wanted to talk about what's happening in the resale market as well, and not just condos, but everything. And as we can see from the chart on the left here is that we saw a pretty nice rebound in sales activity between April and May, about a 55% jump in sales activity, which made all the headlines, right? Sales activity rises 55%, but take into consideration, this is off of a very depressed April level of less than 3,000 units. It was 3.5 times lower than what volume usually is. And it's still about 50% lower than what you would normally see for a May period. So we've made good progress, but we're still well below those levels. However, as you look through the weekly numbers that are coming through mid-month stats for June, it's showing you that we're getting closer and closer to those year ago levels as we move through this sort of transition phase. And in fact, when you looked at May as a whole, it actually looked pretty similar to sales volumes that you would see in off-season periods, like in December and January. So we're moving from a very dysfunctional trading volume, which would be in April, to one that's starting to normalize in May. And as we move through the rest of the periods, we can actually start to see those improve further. So we're bouncing off of that April low, but we're still 54% lower than what we were last year. In terms of new listings, sales have actually been outpacing new listings for the last several weeks, and this is helping to stabilize the market. And in fact, when you look at the sales to new listings ratio in May, it's very close to what it was in May of last year, right around 50%. And 50% for a sales to new listings ratio is a comfortably balanced level, right? A balanced market is between around 40% and 60%. So 50% is right in the sweet spot of a balanced market. And when you're in a balanced market, you typically see some price pressures, but not a lot, usually between sort of 3 to 6% is what you'd expect to see when the sales new listings ratio is around 50%. And in terms of active inventory, months of supply saw a pretty sharp drop. So in April, we saw that months of inventory rise above 3.5, still not considered to be a buyer's market, kind of on the cusp, I would say, of a buyer's market. But we saw that number drop pretty quickly in May, back down to 2.5. So again, not as tight as the market was throughout most of 2019, but still characterizing what I would consider to be a balanced market. And as this happened, we've seen prices actually jump a little bit. Now, the numbers can be a little volatile because of low trading volumes, and we're seeing some pretty wild swings in the distribution of sales that are occurring by price range. It's creating a lot of noise in the data, and it's actually pretty difficult to figure out what's actually happening to price. But if you look at the overall headline statistics, what they would have shown you is that between March and April, average prices declined by 9% in that month. Again, there's a lot of statistical noise in that. But between May and April, they recovered by 5%. So they recovered more than half of that decline. And they're still down by about 5% from their February peak. But I would actually argue that in February, prices in the GTA were starting to overshoot. We were starting to see a reemergence of very sharp sellers market conditions and overheated conditions. And I was actually getting a little worried that we would see price inflation run away again and there would have to be another correction down the line. But what we've seen through the course of COVID-19 is actually a situation where we put average prices back on trend with their 5-year level. So that's kind of that orange dotted line there, the 5-year trend. That little mini correction that we saw and a bit of the bump that we saw back in May puts us right on course. And in fact, when you look at the year-over-year change at 3%, it's very characteristic, again, of a balanced market. The sales new listings ratio of 50%. Historically, when you look across time, that would pinpoint a 3 to 4% increase in price. So we're right on target and seeing prices, for the most part, I'd say stabilize. Yes, they're off perhaps from the highs that we saw in February, but kind of really back to where they were in the later part of 2019 and still up on a year-over-year basis. One of the interesting things that we're starting to see happen when you look at housing types across the GTA is that the detached segment's actually starting to outperform. The share of sales going towards detached properties was at its highest level since 2016. Almost half of all sales activity in May was within the detached sector, whereas you were seeing actually those shares decline throughout much of the past few years as the housing prices within the detached sector grew very quickly. There was a bit of a correction and overvaluation, particularly in some of the 905 markets. But now we're starting to see that sector actually grow the fastest. The volume of sales that occurred between April and May was fastest amongst the detached sector, whereas the drop in activity was in fact mostly acute within the condo apartment sector. And what we saw was that the percentage of overall sales that went to condos was at its lowest level in 5 years. It dropped down to 22%, and it dropped lower than the semi-row and town category for the first time in a number of years. So again, I think this kind of speaks to the overall composition of who's been impacted during this recession, right? Younger individuals usually looking towards the condo market as their entry point, whereas the relatively unscathed portion of the economy is still active in the market and out there looking for an opportunity to purchase during a balanced market environment, because it's something that the GTA market is not used to seeing. And in fact, as you see on the chart on the right, for the first time since 2016, the months of supply for detached properties fell below condo apartments, right? Usually you were seeing condo apartments with that tightest level of supply. Now they have the most inventory on the market at 3.1. Still balanced, it's still not a buyer's market. It's a transition from extremely low inventory in years past, but it is a change. It is a change for the market. And what we see is, generally lower priced condos selling very quickly, those that are higher priced taking longer to sell, and that's kind of where the inventory is beginning to accumulate. Whereas within the detached market, well-priced product is actually selling very quickly and inventory is in fact dropping. The lowest amount of inventory in the market is within the semi-row town category. So that's your outperforming sector, which is basically representing the middle of the market, which is great news, right? You want the middle of the market to be performing well because it creates a very strong barometer for recovery, right? If semi-rows and towns, which again are priced kind of in the middle, are doing well, it allows you to fully understand kind of what's happening on a more even basis across the market. And when you break down price trends, the same sort of thing is true. We've seen almost no correction at all in prices for semi-rows and towns, very minor in the early stages of COVID-19, and now you're starting to see that price trend actually even out and move higher. A little bit of a deflation that we saw in detached and condo, very characteristic of the rest of the market where there was a bit of a bounce back in May. And in fact, when you look at condo prices in May, they're still outperforming on a year-over-year basis. Condo prices in May on an average basis were up 6%. Now, most of that is because of the growth that we saw in pre-COVID, right? We're from still a high starting point, and we're relating to last year, we're still up 6%. But if these conditions persist, where inventory remains highest for condos, what you're going to see is that detached housing price growth for the first time in a number of years is going to outpace condo price growth. And I think this is kind of what we were expecting to see as the price trends leading into COVID-19. We're seeing a very reduced gap between the price of a condo and the price of a semi-row town, and to a lesser extent, the price of a detached property, right? Those price differentials were at record minimums, right? So it was starting to suggest that condo apartment prices were perhaps getting a little bit overvalued. Now, there was some policy in place that was helping to drive that increased valuation for condos, namely the increased stress test requirements for borrowers that were basically bringing more down into the lower end of the market. And now what we're seeing with the new CMHC rules, which are going to come into effect very soon, is further tightening, right? Reduced credit scores, lower debt to service ratios. All of these sort of things ultimately end up putting a higher percentage of sales in the condo market. So it's interesting that the market is changing so quickly. It's so dynamic. And, you know, we may actually see more of a recovery for condos coming out of this as a result of these rule changes. So we'll see how it plays out. But certainly some of these trends suggest that, you know, the detached sector and the semi-row in town category is actually outperforming. When you break down sales activity by price range, we've seen, again, some pretty dramatic swings. Between April and March, we saw a big drop off in detached sales that were above $900,000. But in May, we saw those percentages actually rise up very quickly. And within the detached category, the share of sales above $1 million rose during May. And in fact, rose very quickly between 1 million and 1.75 million. Sales between April and May within that price category for detached homes actually doubled during that period. So very strong recovery and activity within, I'd say, kind of the middle part of the detached market, whereas we were actually seeing some share that was gained in April, given back for the lower priced categories for detached homes. Within the condo market, same sort of idea. In April, we saw a huge spike in the distribution of sales below $500,000. But as we kind of moved through May, we started to see a higher percentage of sales activity in the condo market, in fact, go for units that were priced above $700,000, and a pretty big jump back in share for units that are priced above $1 million. So really kind of returning back to their share of the market in March. It was pretty interesting to see how quickly that high end of the market has started to bounce back, both within the detached sector and within the condo sector. And you know, the highest end of the market for the condo market is 2 million plus. It's a good barometer, I'd say. If the high end of the market is doing well, it's usually a leading indicator for the rest of the market. Similarly, if the high end of the condo market is not doing well, it's typically a leading indicator for the rest of the market that, you know, some downturn will happen, because at the highest end of the market for condos, these are usually discretionary purchases. They don't need to happen. So usually it allows you to understand that confidence is improving. And in May, we saw 7 units sell in the GTA for over $2 million. It obviously doesn't sound like a lot, but in April, we didn't see any. And it really kind of brought back the monthly sales volume above 2 million to what it was before COVID-19. So starting to see some improvements really in the high end, I think, is a good sign. If you break down the increase in sales between April and May by region, a lot of it happening in fact, Peel region for both condos and detached properties. A pretty strong recovery in sales activity in Peel. The detached market in York region bouncing back very quickly as well, whereas you know, we were seeing somewhat smaller gains in markets within the city of Toronto, but a lot of that is supply driven as well. Because if you look at the chart on the right, kind of giving you a measure of market tightness, detached and condo apartment prices as a percentage of list price were highest in markets like Toronto West and Toronto East. So really telling you that a lot of homes and a lot of condos still within these markets are selling in competitive offer situations. And those are really where some of the market conditions for both condos and detached properties are tightest, because again, because of supply, right? Supply responds a little bit better out in the 905, whereas homes are still selling often in very, very competitive situations within the core. So now we're getting to 11 o'clock. I want to kind of quickly talk through the rental market, because this is probably where we're seeing the most change in the market. Some very interesting things happening here. So heading into COVID-19, a lot of strength in lease activity, but we've seen a very steep drop off in activity and leases, similar to what we were seeing in the resale market, but also starting to see a bit of a bounce back as we move through May. So a 41% decline in lease activity for condos in May. And in fact, when you look at the first half of June, we saw a 27% decline. So those declines are gradually being reduced, and we're kind of getting back towards normal in terms of condo lease volume. But what's different about the condo market right now in terms of rentals is that new listings are shooting up extremely quickly. In the first half of June, new listings for condo rentals were up 74% year over year. Now, you might think, okay, that's because of Airbnbs. It's not because of Airbnbs. Airbnbs represent only about 10% of the condo rental market. It's because of the fact that we're seeing more condos reach completion this year, okay? There's been a lot of condos under construction in Toronto for a lot of time. And we've seen in the last couple of years, completions actually abnormally low, which is one of the reasons why the rental market has remained so tight. Condo completions were very minimal, but that was bound not to last. With 70,000 units under construction, there was going to be a time when we were going to see more completions. And unfortunately, 2020 was the year when we were going to see more completions, and it's happening. You know, construction projects have faced some delays, but they're still reaching occupancy. And as more condo projects reach completion, more of the units get listed for rent. So it's really just sort of an unfortunate set of circumstances that we're seeing all of this supply come into the market at the same time as immigration has dropped, the same time as the unemployment rate has risen close to 20%. And, you know, demand for more expensive rental properties just isn't what it once was. So as a result, we've seen some deflation in rents, okay? And it's been very real. And, you know, when we looked at the May numbers, rents were down 3.5% year over year. In the first half of June, rents were down 5.7% year over year. So that deflation continues to occur. And in fact, when you look at the average rent in the first half of June at $2,300 a month, it is basically back to where we were in the fall of 2018. Okay, so the lowest levels of rent that we've seen in a year and a half. And it basically erased all of the rent increases that were experienced during 2019. So I of the position that this is temporary, but it's important to understand, right? Rents are not as high as they once were. And in fact, rents were already starting to flatten heading into 2020. As you can see in the chart on the right there, we were seeing almost no growth in rents in January and February. And this was happening as we were starting to reach some resistance levels in the market, right? As we hit close to $2,500 a month in the third quarter of 2019, we started to see demand back off a little bit. And as this happened, rents started to flatten out. And we were pretty comfortable with rents remaining stable in 2020. You know, we were expecting that there would be a sufficient level of demand to absorb all of the new rentals that were going to come in from condo completions. But with how demand has changed, you know, because of the nature of job losses, because of the reduction in immigration, we're going to see rents decline this year for the first time, probably since the data goes back to 1990. You know, I looked at a long-term time series. It's very, very rare for rents to decline in Toronto. But this year, because of how unique this situation is, it's unprecedented to see demand and supply move in that opposite of a direction. Now, if you break down the rental market between furnished long-term units and unfurnished long-term units, it does tell a little bit of a different story. So the chart on the bottom there shows you furnished units that are being rented out in the condo market as long-term units. So more growth in listings. They're up 62% year over year, but take a look at the volume, right? 556 new listings coming in as furnished long-term condo rentals in May. Only a couple hundred units more than what we saw last year. So I'd say so far, the Airbnb effect has shown up in the data, but it's been overblown to some degree. And, you know, we may see more Airbnbs being converted to long-term rentals. You know, we may have only just seen the beginning of it. It's hard to say, but so far, even during this ban on short-term rental operators, we haven't seen a huge spike in long-term units offered furnished. Now, we've seen growth off of a low base, but still representing only about, you know, 10% of the market. But we have definitely seen a notable decline in rents being offered within those properties. As you can see in the table on the bottom, an 8.7% year-over-year decline in rents. So our expectation is that this situation is unfortunately going to continue to unfold for probably most of the rest of the year. I'd argue that we've already seen most of the decline in rents. We were projecting around 5 to 6% decline in rents for 2020 as a result of the, again, sharp reduction in immigration and the high levels of supply. And as you can see from this chart, there's a very clear negative correlation between rent inflation and the number of units that are being delivered in the condo market on an annual basis. We'll see somewhere between 20 and 25,000 condos complete construction this year. And, you know, that's the highest level that we've ever seen. So again, it's just an unfortunate timing that this is happening while demand is taking a bit of a hit. But what I'm seeing in the market is that when we look at rents on kind of a weekly basis, they're starting to show some stability. And the number of leases is actually starting to grow faster on a weekly basis than the number of new listings. And this is helping to stabilize the market. And I think what's happening is that renters are out there now looking at how much of a discount there's been, right? If you can save 100 to 200, sometimes $250 a month off of rent versus what you're currently paying or what you were in the market for last year, renters are jumping on it. And as that's happening, we're starting to see some stability in the marketplace. So again, we're in for a little bit of a weak period this year for rents, but my position has been that we're still undersupplied of rental properties, and the longer term trajectory for rents is still up, and the longer term trajectory for vacancy rates is still down. And this year, in fact, condo investors are still going to be okay with renting out their units at a slightly lower rent. What we looked at was the average carrying cost per square foot for units that are coming to completion in 2020. And based on the fact that they were bought several years ago at less than $700 a square foot as pre-sales, with interest rates below 3% and with a 20% down payment, including your mortgage fees and taxes, you can rent the unit out at, you know, a cash flow of about $200 to $250 a month. And that's based on the fact that your carrying costs are only $335 a foot, whereas current market rates in Toronto are $375 a foot. So that tells me two things. One, investors aren't going to be overly motivated to have to sell these units, right? They can hold on to them because they bought them so long ago. They've seen such a big appreciation, and the holding cost on it is relatively low versus what the rent levels are. But it also tells me that they're able to reduce their rents pretty quickly because they have that buffer, right? An individual investor is not a professional management company. Their goal is to rent the unit out as fast as possible to cover their mortgage. So if they were able 2 months ago to get, you know, $250 a month in positive cash flow, today they'll be willing to reduce their rent by $250, but still achieve neutral cash flow. So that allows some wiggle room in the market just based on the fact that investors have that sort of cushion to be able to reduce rents, and the fact that we're seeing so many of these units come to completion. So I'm a little bit over time here, but I wanted to end up on this slide just basically reiterating the fact that we are going to continue to see low vacancy rates. I think, you know, we could have another full presentation just on the rental market and demand versus supply. We've seen structurally low vacancy rates in Toronto for a number of years, condo vacancy rates at less than 1%, purpose-built rental at around 1%. And really, if you take a look at the chart on the right, we're still not building that many rentals, okay? Almost all of the apartments that are under construction are still condos. And what we've come to learn is that even with a high percentage of condos being pre-sold to investors, it's not enough over the longer term to satisfy rental demand. And we would need to see that number of units that's under construction as purpose-built rental at 13,500 be at least 3 times higher than what it is today in order to satisfy rental demand over the longer term. So we've made good progress. We're seeing the supply pipeline for rentals grow, but it's going to take a long time for us to eventually meet demographic demand, because eventually we're going to get out of this and we're going to continue to see immigration rise, and we're going to continue to see an undersupply of new housing. And what we'll be left with after, you know, prices stabilize and we see tighter mortgage policy come into effect is increases in rental demand. So those that are in the market for a rental, now's the time. You're going to get a good break, but it's not going to last forever. So I think I've gone 10 minutes over. So if there's any questions, I'm happy to take them.
Well, first and foremost, I want to thank you, Shaun. This has been, you know, I agree with one of the comments, incredible information, and you've just basically solidified the opinion that this is just a pause. Basically, it's more of a little bit of a slight reset, right, on some of the markets. it's almost like it was needed to put things in perspective before we get back to business again.
I agree.
Right. So does anybody have, here's a question for you, Shaun. What impact, what do you mean by RTA there, Thomas? What impact has the RTA have on the rental market?
Residential Tenancy Act.
Oh, there you go. Residential Tenancy Act. Oops.
In what specific aspect?
With all the rules that they're doing, really protecting the way tenants' rights are, controlling what you can increase your year over year, rental rates and stuff like that. So,
well, it's I mean, it's important to make the distinction that anything that's occupied, that's been occupied after 2018 is not subject to rent control, right?
Yeah.
So that was a policy that was put into place by the Ford government to encourage new rental housing development. And in fact, it's been very positive in growing the supply pipeline of new applications for purpose-built rental development. So I think that's a key policy tool. But I also think that should encourage condo investors as well, right? So, recognizing that, when your unit comes to completion, you're not necessarily held at 1% growth in rent, even if you do lock in a tenant today at lower rents, right? You're not held to that guideline amount. Now, these policies can change. It's a very fluid environment right now, but for the time being, I think that policy is promoting new rental supply, which is obviously helping to move the situation in the right direction.
Fantastic. Thank you. Did I answer your question, Thomas?
yeah, for the most part, it's just like he was saying before, it works now, but then if you get a new leader in, they could change it, and who knows what will happen, right? Like,
Well, that's
Yeah.
yeah.
Yeah. Well, I'll say that there's a big push. There's a big push across all levels of government to encourage rental housing. That federal level, municipal, and provincial. And I have a hard time seeing any policy come in that would restrict new rental housing, regardless of who's in charge. So there may be some tightening of that policy, but to have it move to a hard line rent control across the board or vacancy control situation, I don't think is going to happen.
Yeah, I think the reason for my question too is more or less because I've had clients this year whose tenants were under lease and they just uppity and left, and they're all calling me, "What can I do? What can I do?" And I'm like, "You're effed. Like, I don't know what to tell you." And I think that's what I mean, though. A lot of my clients are like looking at the Residential Tenancy Act as a hindrance now in the rental market because they have no control. If a tenant decides to leave, they leave. If they ruin their place, they ruin their place, And that, I guess that's why I was asking the question, right?
Right.
In my humble opinion, that's just the risks that any investor takes. They rent the house or they rent. Listen, I've shared it with the group. I'll share it again. During this pandemic, I lost a key tenant in one of my commercial properties. And the easiest thing for me to do was to accept the surrender of lease instead of actually trying to pursue. I mean, it didn't make any economic sense at this point, right? And I just chalked it up to, I'm a land, I do have a portfolio. I invest in real estate, and that's the risk I take with it. So
yeah, for sure.
Yeah. But thanks for the question, Thomas.
Yep.
Are there any other questions out there for Shaun before we let him go? Well, it seems we're good, Shaun. I want to thank you again for being such so willing and giving with your time to our entire office. It means a lot to me, and we'll be talking again really soon. I haven't reached out to you yet this week, but it was my intention, believe me. But how you blink and it's almost Friday already, right? And
I know.
And it's not because I'm enjoying the sunshine, that's for sure.
Okay, thanks for having me. Really appreciate it. Anytime you want me back, happy to do it.
Yeah, we'd love maybe I'll talk to you about some of the information you have. If we can have any little tidbits here and there for our team, that'd be fantastic.
Yeah, no problem. We'll do.
Thank you very much, Shaun.
Thanks again. Okay.
So to everybody else who's on the call, we did have an intention to have a little bit of our own office meeting, but we are just going to touch on just for our SafeBridge partners here, our mortgage brokers. There were some changes that were made through CMHC, obviously, and then the next couple of days it was Genworth. But I'd love to hear from John and Ramon. One of you, both of you, take your turn. Fight it out here on live Zoom if you want to, right? But we'd love to hear from you on what you're seeing in the lending market, and maybe some tips of what our agents can watch out for, especially, right, when it comes to what bank policies are and how they're acting, time frame with mortgage requirements for the process. Anything you can share would be fantastic.
Sure, Tim. Thanks. Ramon and I, we have a couple of things we want to touch base on. We're going to quickly review the mortgage rule changes that happened with CMHC, give a quick rate update, also give a bit of some stories on some clients that Ramon and I have helped in some financial difficulties over the past couple of weeks, as a lot of people have been getting into these situations. But let's start off with the changes by CMHC. So for those that don't know, CMHC announced that they're going to be in making it a little bit more difficult to get CMHC insurance, and that they've increased the qualification for minimum beacon from 600 up to 680, and also amended the maximum GDS and TDS from 3944 to 3542. So what does that mean? It's essentially approximately a 10% decrease in what someone would qualify for if they're purchasing with less than 20% down. Now, keep in mind, this takes effect July the 1st. So anyone who gets a mortgage commitment, not in a pre-approval, but an actual commitment for a purchase by July the 1st, you won't have any issues with getting the insurance. And yeah, so that's what's going on with CMHC. It's a little, I don't know, the way I look at it, considering what CMHC had announced a couple of weeks prior with their projections to price decreases. I think they're trying to do the prudent thing in their point of view, considering that they're a crown corporation. At the end of the day, our taxes help CMHC. So if they're kind of projecting decreases to prices and maybe some costs on their end, they don't want to get the Canadian taxpayer in trouble. Now, that being said, I don't think it's a huge concern right now, considering that there are two other insurers in the market, Genworth Financial and Canada Guarantee. There have been some rumblings that there might be some changes, but nothing official has come out yet. So I would say for now, it's just business as usual. And that's basically it for the mortgage rule change. I guess, Ramon, if you want to take it from here.
Yeah, so one, to give you an overview of what's happening with interest rates out there. Obviously, when the pandemic hit, the interest rates actually increased, and that's due in part to risk premiums, right? So the lenders were looking at it going, well, you know, are we going to loss provisions, things like that. But obviously, as the government came in and bought corporate bonds and also bought mortgages off their books, that reduces the risk premium. And so what that does is reduce the interest rates. And obviously with bond yields being so low, that margin between bond yields and what they offer to clients has obviously shrank. So interest rates are actually lower than they were pre-COVID, which is a really good thing. But we also see that on the alternative lending side and on the private side, interest rates have actually decreased as well. So that's really positive news. We're seeing some incentive programs, such as we have a lender right now who's willing to pay 3 months worth of interest, right? Which is fantastic, and offer really low rates as well, right? So questions we get asked as well is, will a lender use SURB to help qualify an application? The answer is actually yes, but the caveat is that it can't all be SURB. So really what we're looking at there is that a couple buying a place, if let's say the husband or wife, was unemployed and had to get served, then really we can look at as well that part, but also the spouse's income to help qualify. So, the deal is not necessarily dead, right? Other things that John and I are seeing as well is, an uptick in regards to refinance applications. Clients want to take advantage of these low rates, but also to consolidate debt. So that's what we're seeing on the interest rate front, and also in regards to some incentive. In regards to underwriting, we're not really seeing lenders being very strict, but one thing that we have noticed is that there has been a lender out there that came out and said that if a client is buying a rental property and they're using funds from their home equity line of credit, so they already own a property and they have a home equity line of credit out there, they will not be able, just for this one lender, not be able to get financing because they're using funds that are borrowed from a line of credit, right? Other things in respects to individuals that have home equity line of credit, other lenders have actually come out and said that if, let's say, for example, you have a $500,000 line of credit and that you're only using $200,000 as a down payment for the rental property, what the lender has said is that we will not qualify just using the payment on that 200,000. We will actually look at the whole limit. So obviously that will impact your borrowing capacity, but there's ways around it, and really it comes down to choosing the right lender. And obviously John and I work with our network of lenders, but either way, we're seeing some good applications out there. And we're not seeing a lot of applications where clients are asking for serves, but we at least have lenders that will look at that aspect of financing. John?
Very good.
And in terms of like some stories that we have, I've got a story, Ramon's got a story about some two pickle situations that I think agents should hear, because there's always solution really, or for the most part. I had a client of mine reach out to me where his wife, prior to COVID, she had just gotten back from mat leave, didn't have the number of hours needed to be able to qualify for EI, subsequently got laid off, wasn't able to get EI. Then when the lockdown started, he got negatively impacted economically as well, losing quite a bit of his income. And he's self-employed, so he had quite a bit of debt as well. And he was like literally at the point that if we couldn't get him any money, he was going to have to sell his property. And that was the last thing that he wanted to do. And funny enough, this was actually still in the middle of this was back in April, when a lot of private lenders had already started scaling back in terms of like loan to values that they were doing. I was able to arrange a private for him for up to 80%, which was enough to consolidate all of his high interest credit card debt. So he got rid of all of those payments. And then we got enough money for him to basically pay his first mortgage for the next year, and also capitalized all of his mortgage payments in the private, within the private mortgage. So essentially, the only thing that he has no outstanding bills any longer. The only thing he has is just the utility costs of his home to keep afloat. And his whole plan is if he doesn't get back onto his feet economically in the next 12 months, he plans on selling in 12 months. If that doesn't happen, or if things line up the way we hope they will, we'll just refinance his mortgage when it's up for renewal in a year, the private. So it's good news, especially considering that a lot of times we only hear bad stories of people having to lose their homes. And there was like a story a couple of weeks ago in the Toronto Star about, I believe it was in the Toronto Star, where someone was negatively impacted. They were forced to sell their home. They ended up having a $31,000 penalty to break their mortgage. So it's great that we have solutions here at SafeBridge to help clients that may get into these financial binds to not have to take such a drastic measure as selling their home, so long as they have the equity in their property that we can lean against. That's the story that I have. Ramon also has a pretty interesting story as well.
So I had a client who purchased pre-COVID, and what had happened is that there was at least a 70-day closing. So this happened end of June, which was closing. And what had happened is that actually the client needed to sell their principal residence because they actually bought a new principal residence pre-COVID. And obviously with the lockdown and all the measures that were going around, that he was having a difficult time selling their property. So there was no firm sale for his property. So what we had actually arranged was private financing for the existing principal residence. So the client was adamant and saying, Ramon, we have to close it. I'm like, no problem. You have sufficient equity in your home. Let's get you that private financing. So some people might be asking, well, why didn't he just get a bridge? Well, in order for you to qualify for a bridge, all lenders require that you have to have a firm sale. So be cognizant of that, is that if they do not have a firm sale, lenders will not offer a bridge financing, which is technically a promissory note. So you actually have to look at the application as if you're going to hold both properties. So in essence, we got private financing for this client. The client was relieved, very happy that he was able to close his home and obviously still keep the property on the market, and he does intend to sell it. So that was a win-win for everybody.
Great.
Yeah, that's pretty much it. That's everything that we've covered. If there's any questions that anyone has, we're more than happy to take them.
Yep. Anybody have any questions? I know we have one quick question about, does he need an agent?
It's actually an old banking colleague of mine, and he already has an agent, which is an old colleague of ours. But
Listen,
if that changes, I'll let you know, Monica.
listen, I mean, that's just the way, just the way we roll here. You know, I mean, we're always looking for the solution in the problem, right?
Exactly.
In all crisis, there is opportunity. One more question is the rates. Yeah, quick update on rates, if you don't mind. I know that they fluctuate and they're very different, but you know, if you don't mind just giving us an overview on your variable, you know, 135 kind of rate.
Well,
You want to answer that, Ramon?
yeah, so you could get variable rates as low as 2% right now for high ratio mortgages, right? You could get fixed rates in the low twos as well, like we're seeing 2.19%. And that's for high ratio or anybody who has a 35% down payment. If you're looking at, you know, right in the 20% down payment range, you're looking at 2.5, right, for a fixed rate. And variable rates are still very low. So once again, low twos. Let's talk about alternative financing, because I think it's very important to have those flexible options. Alternative lenders have lowered their rates as well. So we're looking at rates at roughly 3.6%. In relative, compared to conventional to alternative, it's like comparing apples to oranges. You can't, because obviously with alternative, they have more flexible guidelines. They could go to borrowing ratios up to 60%. What that means to you is that they could get more money, right? So if they've been impacted by this pandemic or what have you, or even self-employed individuals, alternative lending is a great route to go. And so that's about it. Also, reverse mortgages. Reverse mortgage rates have actually come down too. So all in all, interest rates have come down.
I'm not a very big fan, I'll be honest, with reverse mortgages. You know, I'm not a very big fan. But I do have one question for you, if you don't mind. Percentage of the applicants affected by the new CMHC guidelines. And the part B to that question is, do the other alternative insurers have the resources to take on people who are not going to CMHC anymore, right? Like, do they have the capacity to take on all these new applicants who don't qualify under the CMHC new rules?
Well, in that regard, in regards to individuals that had default insurance, from what we gather and what we see, is that that's such a small percentage, right? There wasn't like in even our book of business, we're not seeing clients who are putting like 5% down. So in my eyes, and what I see on the ground floor is that we just don't see that. Like, so is the impact going to be huge? In our eyes, and with SafeBridge, we don't see it. We don't see that that's going to be a huge impact on the market.
That's fantastic.
Shaun, what would you say?
Yeah, same thing. Like the first time buyers that I'm helping, for the most part, maybe it's just myself, but they've all have 20%. And most of the time it's because their parents are helping them with the 20% to get into the Toronto market. The only times that I've helped clients where they're putting less than 20%, they're not buying in Toronto. They're buying maybe in the 905s, but really not in Toronto. So I don't see it all that much. And that being said, like CMHC, I think they're just they are the #1 insurer. And I think that it could just be that they're trying to minimize their risk with the amount of business that they have. And there's always room for these other lenders to step in, or these other insurers. Like Genworth at the end of the day is a huge financial institution, and they can definitely step in and take on some business. So again, I don't think it's going to be a huge issue. If everybody else changes rules, that could impact certain areas, I think, in the GTA. But for Toronto core, for the most part, where I think pretty much everybody here on the conference call primarily does most of their business, I don't think you're gonna really see that impact that market.
I'd love to see.
You could, sorry, Tim, you could see it as 2 against 1, right? The fact that you have now 2, private mortgage default insurance company against, the big Crown Corporation, I think it just offers so much more flexibility, right? And so much more opportunity for both those private mortgage default insurance companies.
Well, I mean, Sadal, who's the CEO of CMHC, I mean, they're supposed to have a national housing policy, and yet, he says, why should everybody own real estate, right? People should be renting more. So it's interesting how Crown Corporation, that is supposed to have a housing policy, is talking about, people renting more and not buying. The question I have here is, well, one point I'd like to make is I'm wondering, sometimes when I hear these conversations about the banks of mom and dad, I'm wondering what the adoption rates are of new children who want to get adopted by new parents, We've never done a study on that, right? Nobody's ever done a study on that. But the other thing is, I had a comment here from Giselle about why I'm not a fan of reverse mortgages. Anything that chips away at your equity in your home, to me personally, where you wake up after a certain amount of time and I'm not a big fan of. I'd much rather, we just talked about rentals. I believe it's easier to cash out and invest the money, right? And that's just me, right? I know that rates are really low right now for reverse mortgages, but I just think that you could do so much more with your money than having it chipped away, payment by payment, by living in it. So,
I agree with you, Tim, to an extent. Like, I think it all comes down to the person's situation. Why do they need the reverse mortgage, right? I know myself, I have a client or a family right now that's considering doing a reverse mortgage. The trouble is trying to convince the kids usually, because the kids want that money. But anyways, but
that's the wrong reason, right? To sell the property.
Yeah, that's the wrong reason, definitely. But in this situation, from my understanding, it's a family friend of mine, and they, their parents both have dementia, and from what they've researched is, but people who have these degenerative illnesses do better when they stay in their home. So. The problem with them, they want to keep their parents in their home, but the cost of keeping the parents at the home is so high, and unfortunately the kids just can't afford it themselves, and the parents don't have huge savings themselves to be able to pay for all the specialized services that they want to get. So this is the recommendation that I had for them. It's well, listen, we can always, if you want to help your parents, we can always do a line of credit on your house and do something like that, or we could look at doing a reverse mortgage for your parents.
In that case, obviously, there's always a situation where it makes sense, right?
Exactly.
Guys, I want to really thank you. We've been on the call for about an hour and a half, and we just want to provide opportunity for the update. I really want to thank you as well for providing this information. Before everybody goes, July 21st, mark your calendars. That's going to be our semi-annual launch meeting. We're not waiting till September. We have special guests in Jason Mercer, and we also have John DeMichelle from TREB talking about the market from a 7-month past to present, and what TREB is seeing as a go-to in the market of where things are ramping up and moving forward into the next 6 months into the fall. So I think it's going to be a fantastic meeting. A lot of us are going to have staycations. I'm not sure many of us are going to be going to, well, I guarantee you won't be going to the US before July 23rd because the borders are closed. So, you know, it's by design that we've done it July 21st to make sure that you're all here. The other thing is we are planning a social gathering. The social gathering, our first one will probably be at St. Clair on the back patio, second floor, a little barbecue. But we are, you know, we want to make sure that there's a lot of respect and social responsibility in the way we plan it, both not just for externally, but for internally as well, for those who want to attend. We want to make sure we stagger it, and we're just trying to work through everything and pick a great sunny day like today. So it'll be fun as people come and go. So watch for our emails for the social gathering. We're going to have a little barbecue at St. Clair, and please circle your calendars for July 21st. And this Monday, there'll be an hour with Tim. I'll be talking about all the office things that we did not talk about today. Okay? So with that, I want to thank you for being here. Have a wonderful day. This is recorded. It will be posted in our networking group and our YouTube channel. So you'll be able to watch it all over again and take your notes. Okay? Thank you, everybody.